There is $10 trillion invested into ETFs. And for good reason. ETFs are arguably the best way to invest for the large majority of people, myself included. Do that and become rich. Simple, right? Well, if you're just starting out, it can feel like a bit of a minefield. What is an ETF? Which one should you pick? And how can you invest your first £100 into ETFs in the simplest possible way to minimize your fees and maximize your returns? That is exactly what we're going to cover in this video. Over the last 8 years, I built my own investment portfolio up to over £100,000, and most of this money is in low-cost index funds and ETFs. So even as someone who has been investing for years, I follow this exact same investing strategy. Why? Because although investment values can go up and down and you can get back less than what you invested, this approach can not only help to grow your wealth, but it's low fee, hands off, and passive. I also wrote a book talking about this too, and I'll be explaining absolutely everything that you need to know. When I started investing, I had no idea what an ETF was. I thought investing was like the Wolf of Wall Street, looking at graphs and charts all day and frantically just buying and selling stocks. Luckily, this is very wrong. So what is an ETF? It stands for Exchange Traded Fund. What does this jargon mean in simple terms? The word fund means it's a collection or basket of assets, usually stocks. And exchange traded means that it trades on a stock exchange. So an ETF is a basket of underlying assets that trades on a stock exchange that we can invest into. That is an exchange traded fund, or ETF for short. It gets a bit confusing as there are thousands of ETFs available, but we'll come back to picking an ETF shortly. ETFs were first introduced in 1993 and helped bridge the gap between individual stocks and traditional mutual funds, bringing fees down for investors in the process. In reality, any DIY investment platform you use these days will offer ETFs. The real power and simplicity of ETFs is that you can invest into one single ETF, and that will give you access to thousands of underlying companies within that one single ETF. Instant global diversification, but I'm getting a little bit ahead of myself. It's worth pointing out that not all ETFs are created equally. Globally, there are nearly 10,000 of them. There are more ETFs than public companies, which is pretty crazy to think about. Some are active and some are passive. Active ETFs are managed by investment professionals who select stocks in an effort to outperform the market. Whilst they offer potential for higher returns, they typically come with higher fees and there's no guarantee that they will outperform the market. Whereas with passive ETFs, they simply track an underlying index. For example, VUAG is a very popular ETF from Vanguard, who are a fund provider, and this passive ETF tracks the largest 500 US companies, the S&P 500. It is very low fee, and the ETF grows over time as the underlying companies grow over time. Passive ETFs are usually lower fee, but not just the fees. The data shows overwhelmingly that while some active investors and active fund managers can outperform the market in certain conditions, evidence shows that over the long term, the majority of actively managed funds tend to underperform against comparable passive strategies. And they have the potential for higher losses, particularly after you account for all of the fees and costs involved. So ultimately, and to keep our approach as simple as possible, we want to stick to passive ETFs. How do you know whether an ETF is active or passive? Well, firstly, the fee is a giveaway. Higher fee ETFs are more likely to be actively managed. An ETF with a fee of 0.5% or more is more likely to be actively managed. Secondly, the fund page online should say whether an ETF is active or passive. So to quickly recap, as we know, each ETF will track an underlying basket of companies, and the price of that ETF will change over time depending on how well the underlying stocks perform. So how can we actually invest into ETFs in the simplest possible way? First, we need an investment platform to invest on. This is step one of my 3-step investing blueprint. Let's keep it as simple as possible.
And one of the platforms I like is Invest Engine.
They're a low-cost investment platform charging a 0% platform fee, although ETF costs still do apply, which we'll come back to shortly. And they offer hundreds of different ETFs that we can invest into, nice and easy. Second, we need to open an investment account on the investment platform. This is step 2 of the 3-step investing blueprint. By the way, I'll also link my free investing guide in the description below if you wanted to go through these 3 steps we're running through now in more detail. Let's keep it simple once again. Consider using a stocks and shares ISA. We can put in £20,000 each tax year, and the growth, both gains and dividends, are completely tax-free. Invest Engine offer a stocks and shares ISA, so we can go ahead and open one. Third, a decision that can be overwhelming, choosing an actual ETF to invest into. This is step 3 of the 3-step investing blueprint. There are 800 plus ETFs available on Invest Engine. Cutting through the sheer number of options and choosing one can feel very overwhelming. This is usually the toughest decision to make. Personally, I like to stick to global ETFs. Why? As it keeps my investing approach globally diversified and unbelievably simple. Literally, this approach will help to keep your investment approach as simple as possible. It means I don't need to invest into a dozen different ETFs. I can just invest into one global ETF, and my wealth has the potential to grow over time as the global stock market grows. Now, this might seem counterintuitive, as people think investing needs to be complicated, but it doesn't. Most people think that you need to do more, but you don't. One simple low-cost global ETF can give you access to thousands of companies in the stock market located all over the world. Of course, if in doubt, contact a financial advisor, and you can invest into any number of ETFs that you like. That's the beauty of investing. But the longer I've been investing for, the more I appreciate this global approach. It's low cost, passive, and globally diversified, keeping my approach as simple as possible. It also takes all guesswork out of the equation, as the global ETF will auto rebalance or self-cleanse over time as the global stock market ebbs and flows. Here are some of the popular global ETFs available on Invest Engine, and these are the respective fees. It is worth mentioning that each ETF carries its own fee regardless of which investment platform you invest on. Whilst fees aren't the only thing to look for, they are one of the most important. And of course, the lower the fees, the better. All of these are great options that give global diversification for a low fee. Once you've decided on the ETF, you can either invest a lump sum or set up an automatic monthly investment. Start with a lump sum of £100 if you can to get the ball rolling. Getting those first pounds invested is the most difficult, but also the most important step. Then set up an automatic monthly investment. I personally prefer to automate my investing, as this helps me pay myself first every single month and grow my investment portfolio on autopilot each month. And that's it. Boom. You've just opened up a stocks and shares ISA on an investment platform and invested £100 into a low-cost, passive global ETF. You're now investing globally into thousands of stocks in every corner of the world in a tax-efficient wrapper. 10 minutes or so watching this video well spent, I'd say. Hopefully. As always, if you have any questions at all, let me know. And if you want to know more about picking a specific global ETF to invest into, watch this video here.